It's Friday, 9th of January, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, is the oil market about to drown in ramped-up Venezuelan output? But first, Neil Shearing, Group Chief Economist, is with me for a sense check on the opening days of another year in global macro and markets. Hi, Neil.
Hi, David. Happy New Year.
Happy New Year. Quiet start to the year, then.
Indeed, quiet start to the year. Just in case anyone was still in their kind of holiday slumber. They're not anymore, I'm sure.
Oh, absolutely. Slumber's all over. I do want to get onto events in Venezuela. But before that, very quickly, we've just had some US payrolls data. Markets seem to like them. Not huge moves, but positive nonetheless. What would you say are the key takeaways?
Not huge moves. I think it's one of those Goldilocks pieces of data, really. It wasn't too hot, wasn't too cold. And that tends to be the type of data that the markets like. So if you just look at the headline number, it was pretty soft, a 50,000 increase in non-farm payrolls. It's a bit below expectations, broadly in line with our own forecast. Set against that, we had a fall in the unemployment rate. So in the November payrolls report, we had unemployment at 4.6%. That was revised down to 4.5% for November in this employment report. And then the December rate that we got today, down at 4.4%. So we now have the unemployment rate at 4.4% in December. Obviously, we thought it was 4.6% in the original employment report in November. So slightly soft payrolls number, but better news on the unemployment rate. I think so. Take all that together, then I think it helps to allay some of those fears that were building before the holiday break that the US labour market was on the brink of cracking. We'd had a few slightly troubling payrolls reports. It was quite difficult to discern how much of that was about distortions to the data stemming from the government shutdown, how much of it was genuine, what role those immigration curbs are playing in calling payrolls growth and reported payrolls growth in the US too. So all things considered, Goldilocks report, markets, I think, breathe a sigh of relief. We're seeing equity markets up a bit on the back of it. And I think it just, from a Fed perspective, I don't think there's anything in here that's going to alarm officials and mean they're going to be rushing to cut interest rates again soon.
Yeah, I mean, it certainly has been an argument for some FOMC officials, hasn't it? The apparent weakness in the labour market is an argument for an accelerated pace of easing. We had that hawkish cut at the end of last year. Do you see anything that could change this broader narrative of the Fed on the sidelines?
Well, you're right. The next big piece of data that we've got coming is the CPI report due next week. We're forecasting a bit of a bounce back in the core goods number. Remember that in the November CPI data, the timing of the survey around Black Friday meant that we had a slightly depressed core goods number in the CPI data for November. We think we'll get a bit of a bounce back in that in December, but overall pretty modest. So we have core CPI up 2.6% year on year in the December data, headline up to 2.7%. So still above the Fed's targets, but not dramatically so. Again, another Goldilocks piece of data if it comes in line with our expectations. And then in terms of what else might jolt the Fed into kind of renewed action, well, we'll get in the next employment report, we'll get the annual benchmark revisions. So it's possible that those might throw up a surprise too. Maybe the labour market might be a bit weaker than we and others are anticipating. But assuming we don't get a surprise in the consumer price data this week, assuming that those benchmark revisions don't throw up any major surprises, then I think that the Fed stays on hold in February.
You use the name Goldilocks report. That leads me on to this question about the GDP growth numbers we saw towards the end of last year. You talk about today's unemployment report. We're coming off just yesterday's remarkable productivity figures. Putting it all together, when we're looking at the US economy more generally, is this a sort of Goldilocks-y new normal, or are we seeing some one-offs here that won't last? Tell us about the productivity numbers.
Well, the productivity numbers were pretty stunning. So we've spoken at length, haven't we, on this podcast about over the last 3 or 4 years about weak productivity growth in developed markets. The fact that since the global financial crisis, we've had productivity in the doldrums across the developed world. And then the middle part of last year, we started to see a bit of a pickup in some measures of US productivity growth. And then over the past week, we've had data for Q3 2025 productivity growth, and it surged. So we had non-farm business productivity at an annualized pace of just under 5% in Q3. And it was up 4% in just over 4% in Q2. So
Can you
we
give
are
us some
seeing
context there? That 4%, that 5%, how does that compare with the post-GFC period?
So that's a substantially improved performance compared to the post-GFC period. If you look at the pre-COVID decade in the US, productivity growth is averaging about 1% a year. And now we've had 2 quarters where it's increased at an annualized rate in excess of 4%, as I say, just over 4% in Q2, close to 5% in Q3. So the questions we've been having from clients are, A, is this sustainable? B, how much of this is to do with AI? And I think the answers are a bit more nuanced than you might expect. Clearly, there's an AI investment boom going on in the US, but I don't think this growth in productivity is all about AI. I think some of it's just the counterpart of those immigration curbs and clampdowns in the labour market that I just talked about, that means that firms are having to work existing labour and capital inputs slightly more intensively. And then as to the question of whether this can last or not, I don't think anyone, not even Donald Trump, or maybe Donald Trump, but Donald Trump aside, expects that the US can sustain productivity growth of close to 5% a year. But I do think that over the coming quarters and years, we are going to see genuine signs of improved productivity performance because of AI. This is something that's been a kind of major theme of our work over the past 18 months or so. And reflecting that, we think that AI can add about 1 to 1.5 percentage points a year to productivity growth in the US. So if you think about that productivity growth in the pre-COVID decade at 1%, and then you add in the potential effects of AI, maybe we should then think about the US productivity growth as steady state being something like 2.5% a year might be where we might settle. So is it sustainable? Not at 5% annualized pace, no. But something in the order of 2.5%, I think is sustainable and would be still a substantial improvement on what we've had over the past 15 years or so.
To the extent that what's happening in the US could in part reflect some of this AI investment. We were talking at the end of last year about comments from Christine Lagarde about how Europe might be seeing more AI investment. Obviously, AI, huge state policy in China. You spoke about, there's a low productivity problem, not just a US phenomenon after GFC. It was all advanced economies. How far behind are other economies more generally in terms of showing the impact of not just the spending on AI, but perhaps also the productivity benefits that come with all that spending?
Well, I think so far, if you think about those comments from Lagarde before the holiday break, that was not really about what we're seeing in the hard data. It was mainly about kind of anecdotal evidence in business surveys and what firms are telling us. We don't have much evidence of a similar investment boom around AI in Europe to that we're seeing in the US. And related to that, if you look at the hard data that we do have, it's obviously very difficult to get comparable data between economies on some of this stuff. But if you look at the comparable data that we do have in the hard data, if you track imports of AI components, AI-related components, things like semiconductors, all the components that are needed to build like data warehousing, they've exploded in the US. And that's a reflection of the fact that this AI investment boom is sucking in all of these electronics and component parts. We have not seen anything like that surge in Europe and, for that matter, the UK. So I don't think there's much evidence yet beyond the anecdotal that this AI investment boom that seems to be turbocharging business investment in the US and may have some role to play in the increase in productivity growth that we've seen. There's not much evidence that that's playing out in Europe at the moment.
Okay, we are going to obviously stay on top of this and we'll continue to track this. AI obviously a big part of what the team is looking at. But I have to get to the big news of the week. It was last Saturday. Venezuelan President Nicolás Maduro snatched from Caracas, delivered to a New York courtroom to face charges. Now, as that news was unfolding last weekend, you can watch the hot take machine going into overdrive on social media, talking about where's next, where's the Trump administration going to be going into next. Let's talk about return of spheres of influence. US in the Western Hemisphere, Putin has Europe, Xi Jinping in Asia, including carte blanche on taking Taiwan by force, etc., etc., etc. I don't want to dismiss all of this out of hand, but it does feel like at the end of what's already been a long first trading week of the year, it does feel like some kind of reality check is needed here, right?
It does. And as ever, when you get these historic events, I think it is historic. Everyone got those alerts flashing up on their phones that the US had seized Maduro, had arrested him, the head of another sovereign state. It is a historic event. However, I think we just need to, you're right, just to have a bit of a reality check in terms of the macro and the market implications. If you just think about the narrow economic implications of events in Venezuela, they're pretty limited, I have to say. Venezuela, 0.1% of global GDP, just over 1% of global oil production. Yes, enormous reserves of oil, but at the moment, only the world's 18th largest producer of crude, and it's going to take an enormous amount of investment to get production back up. To give some kind of context, it used to be the case that Venezuela was producing 2.5 to 3 million barrels a day of oil. It's now producing less than 1 million barrels per day. So even if you add 250,000 barrels, 300,000 barrels, which some people have talked about, pretty quickly, you're still getting nowhere near back to the levels of production that we had seen only a few years ago. So I don't think there's major macro and oil market consequences, at least in the short term. And that then gets you to the geopolitical implications of all of this. And you're right that this has been framed as a return of spheres of influence, the so-called, I can't believe I'm going to say this, but the Monroe Doctrine, the kind of modern day version of the Monroe Doctrine, in which the US has its sphere of influence in the Western Hemisphere. China has its sphere of influence in Asia Pacific. And in most people's framing, it's been Russia that's the dominant force in Europe today. Now, you can pick holes in whether Russia's the dominant player in Europe or not, and whether this is the return to strongman leadership and the retreat of the rules-based global order. However, I think the biggest weakness in this argument around spheres of influence is that implicit in it is the idea that the US has stepped back as a global superpower. It doesn't want to project itself globally anymore. It only wants to project itself regionally. And that sits rather awkwardly with the facts, I'm afraid. The US is still extremely active in the Western Pacific. It's expanding its footprint in Africa, developing new mines in places like the DRC and Rwanda. It has, of course, had military operations, not just in Venezuela over the past year, but also in Syria, in Nigeria. Saudi Arabia is moving closer to the US as MBS and Trump have patched up relations between the two countries. So the point is that the US is not seeing itself as just a hemispheric power. It's still projecting itself as a global power. So I don't think this idea of geographically contiguous spheres of influence quite fits the facts. Actually, I think still what we're seeing is the world dividing into these geopolitical blocks, principally centered around the US and China, and the global fracturing that ensues from that we've talked about many, many times. And if all of that sounds a bit kind of high level and arcane, then I think it has substantial macro implications and market implications. If you believe in a world of the Monroe Doctrine and spheres of influence, then you should expect the global economy to start to delineate along regional lines. So the US reduces economic and financial ties with Europe, with Asia, and strengthens economic and financial ties with Latin America. Similarly, China reduces its economic and financial ties with Europe and the US and just strengthens its ties with its neighbors. And that's not what we are seeing. It's not what we expect to see in a fractured world. Actually have a pattern of economic and financial market activity that's far more geographically dispersed. So pouring a bit of cold water on the idea of regional spheres of influence.
What I found notable for the past week is just how, maybe it's not surprising at this point, but just how markets have taken this news, as you say, historic news in their stride. We are going to hear about the oil market response in a moment. But financial markets, more generally, S&P are hitting new highs, other equities are trending towards new highs if they haven't already. With all of this going on, the fact is that US foreign policy clearly is in a more assertive and a more aggressive phase under this president. Lots of moving parts. Geopolitical tensions are on the rise, and that's very much one of the core takeaways from the fracturing work that you and the team have been doing. With all of that going on, do you think it would take for markets to sit up and take notice?
Yes, you're right. The market response to all of this has basically been to shrug its shoulders. And perhaps that's consistent with the story that I've just been telling, that the macroeconomic implications of this and the market consequences too of events in Venezuela are pretty limited. So perhaps it shouldn't be that big a surprise that we've not seen big moves in markets. Now, the question is, what would prompt bigger shifts in markets as a result of geopolitical eruptions? Well, I would put Greenland in an entirely different category to Venezuela. Danish territory, NATO ally, any attempt by the US to seize Greenland, I think, would have major market implications. And of course, outside of the Western Hemisphere, if China senses an opportunity here, the US distracted, focused on its Western Hemisphere, makes a move in Taiwan, then that would have major market implications, really substantial macro market implications too. Now, I'm not suggesting that either of those two things are imminent or indeed likely, but if we're thinking about the potential for geopolitical events to really shock markets, I think it would have to be something more substantial along the lines of Greenland, more substantial, Taiwan, even more substantial. That would really be a major, major event. So those are the types of shocks that I think will be much more likely to move markets.
Neil Shearing there on an extraordinary first trading week of the year. As Neil suggested, there is a lot going on pretty much everywhere all at the same time. Trying to stay on top of what's important to you can be a bewildering task, which is why we've designed the Capital Economics platform to give you just the insight you need that matters to you. It's flexible though, so if you want the full picture, it's there for you. But we also have a host of engagement options so you can get the information you need directly from the Economist team when you need it. Find out more about Capital Economics and how we can help you at sales@capitaleconomics.com. One of the options for engaging with the Economist team is our drop-ins. These are our short-form online briefings. We hold them every week across the full range of issue. This past week, the team was briefing on the implications around Maduro's capture. In the coming week, there will be a session on Tuesday on the outlook for a host of critical EM elections in 2026, including Brazil and Colombia. And then on Wednesday, with metals prices going mad, our Commodities team will be doing an online session to take your questions and explain why we think prices of gold, silver, and copper will all be lower by the end of this year. Check out details of those on our events page, capitaleconomics.com/events. Lots of data in the coming week to watch, along with US CPI and PPI. There's China trade numbers for December and full year, UK GDP, and much more besides. We'll be publishing instant reactions to those, as well as more in-depth analysis, including the findings of our latest refresh of our fracturing dashboard. As Neil suggested, fracturing is our framework for understanding how the breakdown in US-China relations is reordering the global economy. And our interactive dashboard shows how the world's countries are aligning within that two-block system. The latest refresh will explore shifts in alignments from India to Saudi Arabia to Venezuela, so do look out for that. Now, towards the end of an extraordinary week in macro and markets, David Oxley and Kieran Tompkins from our Commodities team got together over a microphone to sift through what's happened and what it means for the outlook for oil prices. They talked about the state of Venezuela's reserves, they talked about the reticence of some of the majors to go back into the country, and they talked about this ghost fleet that's been making headlines after tankers have been chased down on the high seas by US forces. It's all very exciting stuff, but what does it all actually mean for where prices are going in 2026? Here's the conversation between David and Kieran now, and it starts with Kieran on how prices have moved since Maduro's capture last Saturday.
When the market initially opened on Monday morning, prices initially fell. And when we look at them now, the price of Brent crude is within 20 cents of where it closed on Friday. So yeah, I think you could definitely characterize it as the market having shrugged off the weekend's development.
The backdrop is key. There is clearly no shortage of oil sloshing around the world. Our forecasts are for a 3 million barrel surplus this year, and that underlies our expectations that the oil price will fall to $50 by the end of this year or come under pressure over the course of 2026. None of this is really changed that? Because I don't think the facts of the ground, with the much bigger players in the market, has changed.
No, not at all. So OPEC actually met on Sunday in a scheduled meeting following Maduro's capture. And reportedly, that was a 10-minute long meeting where Venezuela's situation was never discussed. So clearly, right now, at least, it's not affecting OPEC's thinking. And given that Venezuela actually doesn't have any production quotas from OPEC, it would be a surprise if it did begin to be a factor in OPEC's thinking going forward.
And I suppose underlying all that, there's been obviously lots of attention on the upcoming meetings of President Trump with the energy bosses in the US. It certainly seems as if there isn't a huge amount of appetite or certainly some degree of sort of trepidation on the part of energy bosses to commit capex to Venezuela at this current juncture. So that's playing into investors' minds as well. You know, although given the potential for Venezuela, which we can come on to later on, this isn't going to be a quick win. In terms of how other things play out, I suppose the other key unknown, Kieran, is coming alongside the capture of Maduro is US pressure on the shadow fleet and the broader blockade on Venezuela. Obviously, we saw the high-profile seizure of the Marinera oil tanker this week as well. How do you see that playing out?
I think a couple of the key points to take away, at the very least from what we're seeing so far, is that the crackdown on the shadow fleet through the blockade around Venezuela has been pretty porous. It seems the US administration has been pretty selective on which tankers it has pursued and captured, and much more have been getting through than actually have been captured. And I think the key point is that, you know, President Trump does want that oil to continue to flow. It just wants it to flow to the US rather than elsewhere.
Got started by some of the estimates out there, which suggest that the shadow fleet globally now accounts for around 20% of global oil tanker capacity. So I think that's the key point. I think this is an instance where there is a tension between President Trump's stated target and desire for lower oil prices. Clearly, looking to inter 20% of the global fleet of oil tankers is not consistent with that. So, yeah, I think this porous nature of the efforts to sanction these tankers is likely to remain. Moving on to, I suppose, the longer term potential for Venezuela, I suppose the well-known factor that Venezuela has the world's largest reserves of oil has clearly got a lot of people very excited.
Yeah, I think that has got people very excited as, you know, the situation kicked off. But I think in more recent days, some healthy skepticism has built across that. I think some nuance is required really when considering that factoid and some of the definitions at play that go into that. The key point really is that Venezuela does have pretty vast oil reserves. We don't potentially know just how big.
We put a note out this week, just add some nuance to that. I mean, if you look in the definitions of what constitutes reserves, these should be resources that are geographically feasible to extract, but equally economically feasible to extract too. And I think that the key point with Venezuela is, given just how far oil production in the country is falling and the parlous state of the infrastructure in the country, I think there is lots of uncertainty about the cost of extracting in Venezuela, which casts some degree of skepticism over the precise scale of reserves. One of the key factors when it comes to assessing the size of reserves, and it will play out in the future, is the cost of production.
Yeah, I think the key point to stress is that no one's working with any concrete facts here around the cost of production of Venezuelan oil. There was a estimate from back in 2020 that suggested the break-even oil price was around $50 per barrel then. But, you know, in the 6 years of mismanagement and severe underinvestment in the sector, that price will most probably have risen. The latest best guesstimates probably put those break-even costs somewhere in the range of $65 to $80 per barrel. And I think you actually have to take a step back and compare that to the average break-even price for new projects in the US's Permian Basin is actually $65 per barrel.
Yeah, and I think that's exactly it. It's not just the case of, is Venezuelan oil profitable to extract or not, it should be seen against other alternatives out there, the cost of extracting that. The oil companies who are on the hook for going into Venezuela and ploughing lots of money in there in search of a return have a duty to their shareholders to do that most profitably. And whether Venezuela is the answer to that, remains to be seen.
I think there's also a point in there that, for a few of these companies, they have long memories of having their assets expropriated in Venezuela too. And so surely they would have to demand a healthy risk premium on any investment into the country going forward.
Yeah, there's lots of challenges to expanding its oil resources. Over the longer term, is there the potential for Venezuelan heavy oil? It's similar in nature to the type of oil produced in Mexico and Canada. Is there the potential for this to displace some of those flows?
Yeah, there is certainly that potential there. US Gulf Coast refineries are largely geared towards taking this very heavy oil. They previously imported very large quantities of Venezuelan oil in the past too. And so depending on to what degree politics plays a role in this too, there's certainly the potential for those refineries to take a lot of that heavy Venezuelan crude over, say, imports from Mexico and Canada.
So, Dave, taking a step back, the overall Venezuela point, how would you characterize this in terms of the potential impact on prices this year, but then further out?
Yeah, so I think over the short run, there's some small upside risk to prices over this year, depending on to what extent there's a crackdown on the shadow fleet and through Trump's naval blockade around Venezuela. But I think we have to stress that we imagine that to be a small upside, given how small a producer Venezuela is and how small these trade flows are that we're talking, especially against that backdrop of the oil market that we outlined earlier. But over a longer horizon, this situation has presented a downside risk to prices, depending on, that degree of the appetite for investment in Venezuela's oil sector.
And just to run that point home, small upside to our forecast for prices to fall from around $60 per barrel to $50 per barrel, even with some falling output or potential falling output from Venezuela. This wouldn't be inconsistent with prices still declining over the course of this year.
David, Oxley and Kieran Tompkins on the outlook for oil prices and our $50 forecast. But that's it for this week. We will be back next week with much more from this hyper-eventful world of macro and markets. Until then, goodbye.